All right, we're live back here with the next regulatory panel, and this is more focused around startup fundraising.
Mhm.
Founders always are really eager to learn what the latest is in raising money for their startup, whether to do it in the U.S. or outside. And so it'd be great to know, you know, the best ways that are going on in the U.S. And even if the U.S. makes sense. But Jonathan will first talk about more about IPOs uh, and then Matt will follow up with kind of more the private equity side. I guess is that a fair kind of term?
Yeah.
So, okay, great. So, Jonathan, feel free to introduce yourself. He's kind of well known as the founder of Hackers and Founders,
Mhm.
and it's a global community of what 300,000 plus people now, I think.
Pretty much.
Uh,
We started off as a meetup about 15 years ago in a bar in Sunnyvale, California, talking about, complaining of our lives as being hackers and founders. Those meetups went viral. They've now been held in over 200 cities globally, about 700 countries, and about 300,000 people have attended our events. And after the first few thousand conversations about what a pain in the ass it is to raise funding, we just decided to kind of hone in on that. We submitted a bunch of comments to the SEC when the crowdfunding laws, the Jobs Act, came into play. One thing led to another. I started a conversation with one of the SEC commissioners, and I was tapped to become an advisor to the SEC on capital formation. And I spent a couple of years doing a deep dive on fundraising legislation, what works, what doesn't, why doesn't it work. And to my knowledge, I'm one of the only software engineers to have actually done that. So the problem is that in the United States, the SEC has three mandates: investor protection, maintaining efficient regulations, maintaining efficient markets, and capital formation. But in this country, we've really kind of ignored this whole capital formation piece. So when ICOs first came out, I thought, hey, this is going to be an interesting solution, but it's also going to be a regulatory shit show. And indeed, it has been. And this is why we're having these talks. And what entrepreneurs want to be able to do is we want to be able to issue a token or issue something that people can buy and have people on the internet buy that thing. The problem is that the SEC rightly considers, they're mandated by the Supreme Court from the Howey test, that to say that if you issue a thing, a scheme, an investment contract, a token, and people expect a profit from buying that thing, it's their expectation of profit, that makes that thing a security. The problem is, and the last two SEC commissioners, Commissioner Clayton and Gary Gensler, both of them have said that they haven't come across too many tokens and token sales that they did not think were a security. And everybody in the crypto community is like, screw you, SEC. It's a security. Damn it. We can't sell this on the internet. And a lot of the crypto community has essentially gone offshore and done these ICOs overseas. My thing is if we really do want retail investors, now the government says there's two kinds of investors that can buy these securities: rich people, accredited investors, and retail investors, i.e., the poorest 93% of the population. If I'm going to issue a token and have retail investors buy this, I have to file certain transparency and disclosure rules. And honestly, that should be very crypto friendly. Like in crypto, we're all about transparency. We're all about public knowledge. What the SEC is asking us to do is they're saying, look, we just want you to register these securities. We want you to file your financial information. And we want you to file some disclosure statements to say these are the risks of buying this thing, and these are the opportunities as well. And if we do that, then we can actually sell this thing to retail investors. The problem is that's essentially what's called a public offering, an initial public offering. And the costs of doing an IPO in the United States on legal and accounting is generally, like a full IPO is generally $2 to $3 million. I was kind of looking at this and saying, there's no way that a startup is going to be able to spend $2 to $3 million to do these. Now, there's a couple of tiers of crowdfunding. There's Reg CF, which requires minimal disclosures. You can raise up to $5 million this way. There's Reg A Plus, which means you can raise up to $50 million. And then there's the full IPO, which you can raise an unlimited amount of money. But there's been a lot of work actually doing this to actually make it easier to file these transparency requirements, make it easier to actually file these disclosure statements. And what we're doing at HF.Capital is we've actually been working closely with international stock exchanges, the Australian Stock Exchange, the Toronto Stock Exchange, and the London Stock Exchange. Specifically, cost to do an IPO in those countries is about 500 to 800K, as opposed to $2 to $3 million in the United States. Their regulatory burden is actually a lot less than ours. So what we're actually trying to do is we're taking global tech companies to IPO in markets like London, and then eventually tying up the regulatory systems via tokens so that US and global retail investors can actually buy the stock or the tokens that are listed on these internationally regulatory approved stock exchanges. And ultimately, I think what we all want in the crypto industry is we want to make it much easier to be able to issue a token so that everybody in the world can actually buy it and really democratize access to these things. We're not going to be able to do this until we make IPOs easier. And that's why that's what we're trying to do at HF.Capital. So I'll pause there. I think that's my 3 to 5 minutes, and we'll go over to the next speaker.
Thanks so much, Jonathan. Yeah, very fascinating. Should we do questions first around this topic, or since I think we only have a couple of us, maybe we'll just since we'll stay on topic. Matt, do you have any questions or follow-ups to what Jonathan just talked about with doing IPOs in the UK and other countries?
No, it's interesting. I don't have as much experience in foreign IPOs. The two things I would say just on the US side is actually Reg A Plus. You can go up to 75 million now under.
Oh, okay.
So it's just a pretty material increase. I think it does open the door to utilizing it for tokens, and there are some interesting projects. I won't mention any of them because it's like I'm advertising for them. They don't pay me anything to do that. But there's some interesting projects that do that. And then I would just say a problem with Reg CF that I think makes it less useful is that you have to offer on a platform. Mm-hmm. So everyone has to use like Seed Invest or Republic, and they take just like a big fee. And so it just makes it, I think, less palatable. And I think because of that, Reg CF gets tagged a little bit as like the bad way to raise money. Like for anyone that couldn't raise venture capital money, they then turn to Reg CF, which is not really the way we want to think about it. Really, it should be some types of companies, it makes more sense for them to raise on Reg CF, and other companies, it makes sense to do private offerings. And there should be more of a smorgasbord, is my view, on fundraising options. And this also kind of applies to companies that are growing and thinking about exits. I think it's problematic that companies can only IPO or sell, right? There's sort of two options to get liquidity, and this like creates a bottleneck, and you kind of see that in the market. Like right now, we're seeing it where like every IPO went on hold after sort of like the recent correction, and companies are like holding back their capital. If there's no money, all these great early stage companies that are being pumped full of venture capital money are going to run into a major ceiling. So
absolutely. And our internal estimates at HF.Capital is that there's $2 to $3 trillion worth of just Silicon Valley and US unicorns that are waiting to IPO. If you could actually drop that down to what the average size of an IPO is on, for instance, the London AIM or the Euronext growth exchanges, the average market cap when those companies list is about $100 million. So if you could actually make that the benchmark, there's about $14 trillion worth of equity that's essentially waiting for that liquidity. And so the founders basically and the employees have this stock and they can't sell it. They can't do anything with it. You can't borrow against the value of the stock if nobody thinks it's going to be worth anything. Eventually, what I think we really need to do in this country and globally is we need to kind of start thinking about how do we help smaller businesses essentially raise capital and let people, let their customers, let their stakeholders essentially participate in this. And then the other problem with Reg CF and Reg A plus crowdfunding is that, fine, I sold these shares on the internet via these platforms. That's great. But now what do I do with it? Eventually, if people want to buy, sell, and trade these shares, you're going to have to IPO and list on the NASDAQ, which costs you about $2 to $3 million a year, or list on the pink sheets, which is, neither here nor there. We really need to change our idea of stock markets. We really need to change our ideas of who can IPO. And honestly, other countries are, a couple hundred years ahead of us. London, the stock exchange has been around for 400 years. Companies have just gotten used to growing on stock exchanges as opposed to growing through venture capital. It's a different way of thinking about it, but other countries are actually doing this, and I think we can learn from that in the United States.
Yeah, and I'll just say one other thing, and then I can talk about. And those sort of questions I'm happy we can do questions, or I can talk about private equity as well. But if and I wasn't really around for this time. I was around, but not. But in the dot-com boom. Mm-hmm. There were a lot more IPOs. IPOs used to be a much bigger part of the fundraising ecosystem. Companies would reach like a Series A stage and they would IPO. And I think the bust kind of scared everybody out of the public market. So it's sort of like we had this external factor, I think, that's contributed to our view that the IPO is only for like the biggest and most successful companies. And again, like that's, if you think like a company, pick any of the, the recent IPOs last year, like, Unity or something. Think if they would have IPO'd after the Series A. Think of all the value accretion that regular investors could have acquired by buying into a company, because they were still a Series A and they've grown where they've grown. They would have done that, but instead of it all going to venture capital funds, all the value from that, more people could have gotten in at an earlier stage. And when we talk about things like secondary markets, right, there's a bunch of companies that now you can buy like, late stage private stock for like, companies that are going to IPO or may IPO, right? Like even at that point, like there's like, you're much more likely to have paid way too much, right? So just another reason why, I totally agree. And we didn't talk before this presentation. I'm just agreeing on this presentation that, it would be great to, if, to create a scenario where more people can access good companies at earlier stages. That's really what we're talking about here. And tokens play a role in that. So I'll kind of jump to what happens before, right? So I'm Matt Melville. I'm a startup venture capital lawyer in San Francisco. I have my own law firm. I used to work in big law, but left because I wanted to do things the way that I wanted to do them, and represent in sort of the way that works for me and works for the company, and not have sort of the bureaucracy or institutional obligations that come from big law. So I would say like a significant core of my practice is Web3. And that hasn't changed, right? I think, a lot of, with everything that's happened in the markets, I've actually seen sort of even more interest in Web3. And I sort of view the current crop of companies as companies that are growing for the future. Like it doesn't really matter what the price of, Ethereum is for these companies to build like useful products. So there's a lot of activity in the earlier stages, right? And part of the reason for that, there's a couple of reasons for it. One reason is that there's just a ton of venture capital money, and there's no indication that there's going to be less venture capital money in the near term. If anything, it seems like there might be more, because most people think that this is this recession, or that recessionary situation is a blip. And if that's the case, and you want to put your capital somewhere meaningful, early stage is actually a great place to put it, because all these companies have 3 to 7 year time horizons. So if you're looking for something that's more long term, putting your money into a startup may make a lot more sense than a pre-IPO company, which is sort of has just happened to be ready to enter the public markets at the worst possible time over the last 13 years. So early stage, and going back to tokens here, since we're, we should be talking some more about crypto, not just like the fundraising aspect. You know, early stage companies will typically come to me and have sort of this question of like, do I raise on my equity or do I raise on my tokens, right? And this has become like a pretty common question, right? Like raising on equity is like the traditional way, right? Most people will sell a SAFE to accredited investors. And again, we're always in the world of accredited investors here because these are private securities. So accredited investors are people that make over $200,000 a year or $300,000 if they're married and or have over $1 million in assets, excluding their personal residence. Those people can pretty much invest in anything they want. The SEC kind of says, you guys are smart and rich. You can buy whatever you want. And if you lose your money, don't come crying to us. So the vast majority of startups, Web3 companies, blockchain projects are raising money through venture capital. And over the last couple of years, crypto has really gotten into venture capital, and there's a lot of crypto venture capital funds, funds formed by people that made a lot of money in crypto or are highly focused on the space. And those funds are investing a lot into Web3 and into these projects. And so companies will sort of have to make this decision. Is like, am I going to present myself as a traditional startup in the sense that I will sell equity, and then often you offer a warrant on for your token. So an investor will buy a SAFE and they'll get a warrant, and the warrant will entitle them to some portion of your tokens when you eventually launch, right? Usually it's a pro rata portion of the insider's tokens, based on the amount that you invested in the equity round. And that's sort of one way that that's sort of one fundraising option. And then you have the other one where companies that are very token centric, like, look, we have to have a company because you have to have a company, but really everything is about the value of the tokens, and we're going to sell tokens. In that case, people often use a SAFT, which is a simple agreement for future tokens. It's based on the and it's sort of, companies will take money up front and then give investors the right to purchase tokens. And this is sort of how most companies in this space are initially fundraising. There's this interesting question around, whether something's a security. And the SEC has kind of, put its thumb on the scale to pretty much say that every token is a security except, for Bitcoin and Ethereum, which there was like a statement that was made by a former SEC chief that like gets cited, even though it's not really law. He just like made a statement. I don't really think that Bitcoin and Ethereum are securities, and that's sort of become the like gospel, even though it's not like it was a official position taken by the SEC. But as people expand what tokens mean, and you already are seeing it. Like I sort of see things going in two ways. There are certain projects that are really getting closer and closer to being definitely a security, right? And examples of this are like, I would say, like tokenized NFT projects. Like this is happening a lot. Like NFTs are generally not securities, but once you sorry, I said tokenized, I meant fractionalized. Once you fractionalize something and it's no longer non-fungible, you pretty much created a security. So that's a
You're muted, Matt.
Hey, Matt.
Yeah, sorry.
You were muted. Sorry.
You missed the last 10 seconds.
Oh, I'm muting. Sorry, I'm on my phone and some annoying person is trying to call me, so I got cut off there. So I'll take one step back. So some projects are moving closer to securities, which is by fractionalizing NFTs, for example, or just doing things that really look a lot more like a security. But there's another group of projects that I find very interesting, which, and I think there's a lot of examples in the gaming space where projects are really creating tokens that to me look very little like a security. And there really should be, in my view, a better protocol other than the Howey test to evaluate sort of things like in-game rewards, and other types of sort of token issuances that really, don't feel like securities. And we sort of call those utility tokens, even though there's not really such a thing as like a security or a utility token. And the last thing I'll say, and we can kind of jump back and do a little more dialogue, is you can, as a founder, do a pre-sale and sell your tokens or your stock to venture capital investors. And you can still take the position that what you're creating is not a security. And people do this a lot. You sort of say, look, we're complying with securities laws for purposes of this private sale because we have to, and we want to be really careful. But our position is that these tokens really aren't securities. And as long as you say that and you can justify it, there is a path, though it can be viewed as narrow, to issuing tokens into the market that really don't look that much like securities and are probably less likely to be targeted by the SEC, unless again the founders do sort of things that make the tokens look a lot more like a security. So I'll pause there and we can jump back into the group.
Yeah. Any questions, Jonathan, on everything kind of Matt
No, absolutely. I just kind of want to sidestep into that. And my kind of frustration with the venture community right now is that a lot of the VCs are investing in these protocols in the private market saying, I'm going to get an option to actually buy the tokens when they're released at a steep discount. And what the VCs are really wanting to do is they buy the equity. What they really want is to option the token so that when the token does launch and it shoots up like Solana or Sand or what have you, these VCs have bought the token at like 20% of the cost of what it's trading at eventually. So they're seeing a much faster return on their investment than the traditional waiting 10 years for the company to IPO. They're essentially getting to the token sale or the the initial public offering of the token, 7 years sooner. Like, investment to token release is 3 to 4 years in some of these cases. So a lot of companies that are not interested in releasing their own token long term aren't getting funded. Why? Because the VCs don't make as much money. The companies and protocols that are raising money are, I'm investing in a new protocol, I'm starting a brand new protocol that's going to release a token and it's going to solve climate or whatever. Those are the things that are getting money. But yeah, it's a very interesting as venture and private markets are kind of changing and adjusting to this new reality. It's been interesting to kind of see what's getting funded and what people are raising money for these days.
No, I think it's really interesting. I mean, the protocols do some things to solve for this. I mean, most tokens are locked up. You could argue maybe the lockup should be longer. It isn't usually in the best interest of the protocols to incorporate procedures that diminish the ability for the investor to pretty much just sell out of their tokens and like crank the market up and then like watch it crash. That's bad for the protocol. So there is, I think, aligned incentives from the team to not have that happen. And you see things like slashing and burning and lockups as ways to mitigate that to some extent. I mean, at the end of the day, the VCs want their return, and sometimes that's the only way to get the money to the companies, right? Mm-hmm. I look at we could take an example like Polygon. One of my venture clients invested in Polygon. I think Polygon is great, and they're doing an excellent job. And I think they locked everybody up. I can't talk about it because it's private, but they locked everybody up in a thoughtful way. And the venture capital funds were fine with it because they also have a long-term view on Polygon, and they don't want to just sell out of the position. And that's kind of what you want. If you're building a good protocol, presumably your investors won't want to get rid of their tokens immediately because the long term is even better than the short term. This is like, to bring it back to traditional venture markets, this is why Sequoia has switched their entire fund structure out of the closed-end funds, which usually last for 10 years, to an open-ended fund, because they're like, why should we be forced to liquidate our best investments sometimes? Like, we want to hold I think they invested in Roblox, our Roblox securities until after the IPO, because there's even more potential value there. And that to me is a long-term view, and that's what we want from venture investors should have the longest term view, because since they're investing at the earliest stages. And I think it's just about getting the economics right. And again, a lot of investors, for how smart they are, do not understand the token protocols at all. I'm constantly walking investors through what I kind of view as fairly simple, but they don't understand. Like, where do I put my tokens? I'm like, well, you need a wallet. You need, your fund needs to, oh, that makes sense. I'm like, yes, yeah, makes sense. So again, like there's some bandwagon jumping you see as well, right? Because everyone wants in on, the new token project, and then every fund feels that they also have to participate in that market, even if it's a little maybe outside of their thesis.
I'd also like to tag on that I think there's something else interesting that's happening in the market, is that the SEC also has a carve out for collectibles. Like a baseball card is not considered a security. Why? Because people buy a baseball card expecting to profit sometimes, or expecting to have a bunch of baseball cards and they like it. And sometimes those baseball cards improve in value. The SEC says, well, we don't actually know whose activity is going to make that profit. And so it's the market that makes that profit. And so therefore it's not a security. And so one of the things that's popped up in the last year and a half or two is digital collectibles, or NFTs, or this is why a bunch of the crypto industry is kind of making a rush towards the video game industry. Well, if I can make a collectible digital sword that's an NFT, then that's not a security. And so this is why you're seeing so many of the protocols and so many of the big companies do a mad rush into the video gaming space. Whether gamers actually want that or not is another thing. But there's a lot of money being poured into platforms and protocols that essentially allow little digital collectibles to be created. Why? Because that is kind of an area that the SEC has traditionally said isn't a security.
Yeah,
but it's a very interesting kind of interplay between, everybody's kind of stepping around these rules and stepping around this kind of security landmine. Ultimately, I think we just need to, how do we build software to make the IPO process easier, make this reporting easier? And how do we, take the boring parts of writing a prospectus and these audited financials out for the law firms so that they can actually do the really value-added services, which provide amazing, kind of deep insight and, kind of consulting and advice, as opposed to, copying and pasting different parts of a prospectus together. Ultimately, I think that's where the industry is going to have to go, and that's stuff that we've been working on. I don't know, Matt. I'd love your take on that.
Yeah, no,
that sounds great, guys. And that's we probably have just a minute left here. So I mean, that's a good point to end on, Jonathan. I think that's and for Matt, maybe you want to make final words of kind of in response to Jonathan, and both of you maybe just keep put your information on the chat window so people can reach out to you to learn more about going straight to the IPO as a business. And then Matt, maybe there's some flexibility about doing token raises. Can reach out to Matt.
Yeah, I'll just end on there's a lot of vested interest in the way things are currently done. So it's hard to change it. And law firms definitely don't want the cost of IPOs to go down because they make a lot of money doing $3 billion IPOs. So, in a sense, it's like will require some level of collective activity amongst people in the space that insist in a powerful way upon a better process. And whether it's an IPO or another type of offering, that is, we let the IPO be an IPO and we create something else that works better for crypto. I think that's another thing to think about.
All right, fantastic. Thanks so much. A lot of interesting, unique ideas here. And feel free to reach out to Jonathan. He's got his contact information, I think, on the chat windows. And then I think Matt will do the same. Really appreciate it. We got another panel coming up on real estate tokenizing. It's a lot of the things we talked about, like securitization. And how blockchain technology kind of enhances the ability to do all the things we're talking about, fractionalizing things, securitizing things, even real estate. So we'll be back in just a minute, and hopefully we'll see you guys around.
Thanks, guys.